Welcome and thank you for your interest in joining us today as we discuss the increasingly popular strategy of borrowing to purchase property, all through a self-managed super fund. During the course of this presentation, we aim to provide information that may help to remove some of the mystery surrounding the strategy known as SMSF borrowing. We hope to help you understand the structure required to permit borrowing within your self-managed super fund and to make you aware of the steps involved to ensure you are compliant with current legislation. As with most presentations of this nature, it is important to note that anything that may be considered financial advice in this presentation is of a general nature only. If you think anything mentioned may be of some value to you, we advise that you should seek assistance of a qualified financial planner as soon as possible. My name is Ian Gibson. I'm the manager of the Financial Planning Division of Lomax Financial Group. With me is a person who has recently organised borrowing to purchase a property through his own self-managed super fund. May I introduce to you Greg Lomax, our CEO, a man with many years' experience and a great depth of knowledge in all aspects of accounting and financial planning. Welcome, Greg.
Thanks very much, Ian. It's a pleasure to participate today. As you've said, I've just completed a purchase in my self-managed super fund, so I look forward to being able to share some of those experiences today.
Thank you. Now, one of the important things of how to participate today. We'd like you to use the GoToWebinar control panel on your screen to register any questions, or maybe make some notes and email us later. Details will be available at the end of this presentation. We will keep a recording on file for distribution if required later. Now, in this session, why borrow through your super fund? The reason people have shown interest in presentations or webinars such as this is that many things have changed in the superannuation environment in recent years. People are looking at all options to increase their retirement funding and to secure their financial future. Greg, it wasn't that long ago that borrowing in super was not allowed. And could you just give us a bit of background there on when that started and how it developed over time?
Yes, certainly, Ian. It first came in back in 2007. The first rules through instalment warrants allowed you to borrow through super, and that was certainly a major change in the self-managed super fund area. But unfortunately with that came a lot of complex issues surrounding the underlying borrowings, and in those earlier years it wasn't very popular at all. But in the last, particularly in the last 18 months, the government has brought down legislation to make it a lot more straightforward to consider borrowing strategies, and we can talk through some of those today.
Yeah, sure. So we'll step through some of those in the next few screens. But we'll also run through what you need to do, what each person, if they want to go down this path, the steps that they need. And Greg, I think through your experience, there would appear to be quite a few steps involved in the entire process. Is it something that you handled yourself?
Well, naturally, Ian, I suppose with my accounting and financial planning experience, I had the front running on that. But certainly I would have to advise all who are thinking about going down that track to consider it a two-part process. Firstly, we're probably all familiar with purchasing a property or undertaking that, so that part of it remains fairly smooth in a self-managed super fund, but it's the preliminary work that one has to really focus on to get your super fund in a position ready to buy, and that is the big process that we have to help people understand. Okay.
And we'll also look at the loan serviceability. This is, once again, a little bit different to the loan serviceability issues taken into consideration for borrowing outside of super. So we'll cover off on that too. We'll have a look at the possible costs involved, and then we'll also list the next steps. If this strategy appeals to you, we provide suggested next steps for you to undertake. So why borrow through your super? Someone thinks this strategy is a good one, back in March 2012, the ATO reported that over the previous 4 years, residential property being held by self-managed super funds had grown from $10.82 billion to $14.87 billion. It is worth noting that the ATO also mentioned that possible lack of diversification was of a concern. Now, Greg, in your situation, what was the most compelling reason for you to actually consider borrowing for property through your super?
Yeah, thanks, Ian. Look, I think probably for me, I think it was a combination of two things. The first one of those would have to be diversifying my portfolio and just trying to get something a little bit different in there. And direct property has always had an appeal to me. And the fact that I can drive past it and wave at it and see it and comment on it has some appeal to me. So that was one of the motivating reasons. The other one, Ian, is certainly to do with the tax benefits. There's huge tax benefits, in my view, especially being an accountant, with regard to very much reduced tax rates within the superannuation environment compared to outside of the super environment.
Yeah, I thought that might have a little bit of a focus.
Yes, you could say that.
Yeah. So you have seen, obviously, over the years, all the tax benefits in super. But how does this link with borrowing for property within super? Like you've told us about the tax benefits, but what about capital gains and so on?
Yes, well, certainly there's two aspects of tax that I suppose people would want to focus on within a super fund. The first of those is to do with the reason that a lot of us buy property, and that is that it's really income and capital returns. So in the first instance, with the income return in a self-managed super fund, the tax rates are going to be a lot lower. The second part of those, the potential for capital gains, again, the tax rates are considerably lower in a super fund and can be as low as 0 rating on both of those, income and capital. And I'm sure we can expand on those further in the discussion.
Sure. All right. Now, you touched on diversification. Property may diversify your portfolio, and you mentioned one of the compelling reasons why you purchased was simply to achieve that diversification. In some circumstances, people don't have the assets, for instance, outside of super to be able to get involved in borrowing for property and negative gearing. In those circumstances, quite often they have the assets tied up within their super fund. This is a way, isn't it, of accessing those assets within your super fund to go ahead and borrow for some property.
Look, absolutely, Ian, and one of the big things with people in business today and in all sort of walks of life is that they tend to be very, very committed, and banks ensure that they have a very high percentage of a property held as security. So sometimes people can't find that extra equity to be able to secure a property purchase today. Contrast that with a self-managed super fund where you do have that available equity in the super fund, and you can certainly draw off other assets to assist in the loan repayments. So therein you've got a tremendous advantage to be able to create wealth.
So it really does open up that opportunity of accessing, or not so much accessing, but utilising the assets within your superannuation fund before you meet a condition of release. So it's
absolutely
unlike other superannuation outside of self-managed super.
That's correct.
Now, volatility is a pretty hot subject over the last couple of years since GFC and all that's happened since. And some people see property as being less volatile than on the share markets, and therefore would be a little bit more comfortable with property. I think it's probably inbred for many Australians, and that's the way we're brought up. You've mentioned diversification. How do you feel about the actual volatility of property, and has that influenced you in the way that you want to structure your portfolio now with property in it?
Yeah, good question, Ian. I mean, you know what? Every night I go home and I turn on the news, and one of the things that comes up is the movements in the share market. In the morning, I hear it on the radio, what's happened in the US. Yeah. But I'm not going to hear it about my little property I bought in the self-managed super fund. Some people might say that's not such a good thing, but in the long term, I find it to be an advantage for me. I guess my long-term approach to this strategy for me is that it is a long-term strategy, and it's sort of a steady as she goes type of approach. I'm very happy with having the property in the super fund and not being able to get an accurate reading on its capital gain potential every day. I don't need to know that. What I am pleased about in terms of the volatility stakes is that I do have a stable rental. And I do know that I should be able to adjust that every year to CPI or more. And I also know that the property, which I carefully selected, is in an area that will always have a ready tenant on standby should the other one decide to leave.
Yeah, that's interesting. Where it's almost like a lot of people would do with their shares. Sometimes they just tuck them away in the bottom drawer and don't look at it. And I suppose in some ways you're doing a similar thing.
Well, I think you could say that, but I guess I'd be a little bit more guarded about doing that, having that approach with shares, because I tend to think that they do need the help of, your advisor in monitoring those movements. But in a property, they tend to sit there. We all know that properties can sit around in one particular suburb unaltered, untouched, and they just keep increasing in value. So whereas, with the share market, it is appropriate to constantly review your investments. Yeah. And it's slightly in contrast to that with a property purchase.
Yeah. Now, what about the... we've had discussions in the past, and you've mentioned this aspect of forced saving. So in a case of borrowing for a property, how is this forced saving, how does this work?
Yeah, it's just something. In my view, it's a forced saving, because not only are you forced to make those principal and interest repayments, and by the way, you can have interest only, but I don't know why you would in a self-managed super fund. I'd always prefer principal and interest. But to me personally, I find that an additional motivation exists to make additional repayments on the loan through non-concessional contributions. So whereas in the past I may not have been as motivated to make non-concessional contributions, that is, contributions outside of the amount that you get a tax deduction for, I may not have been as motivated. I'd try and think of other ways to spend extra dollars. Now I am particularly motivated to put additional funds into my super fund so I can pay them directly off that loan and get the loan repaid quicker. And that's why I consider it to be a personal forced saving in addition to the compulsory principal and interest repayments.
Now, you've just mentioned a consideration there in paying the loan off early, and it's something that in an investment environment outside of super, a lot of people would tend to just pay interest only and maintain the actual principal there and get the tax benefits of the interest deduction. Now, in self-managed super, obviously it's a very different environment with a lower tax rate and everything, so there are really different playing rules, aren't there?
Yeah, there certainly are, and in my view, those rules tend to swing towards trying to pay off that loan as quickly as you can, and that way you're creating more wealth in your super fund, and that wealth is coming in at an extremely low taxation rate, and in some cases a zero rate. So that provides pretty good motivation to reduce a loan that you're paying interest at 6.5% down to zero as soon as you can, and thus the attraction for the forced saving discussion and non-concessional contributions.
Yeah, that really does bring us back to that forced saving term. Now, with all of these different tax rules within super, there is a very powerful capital gains tax where it reduces to a 0% on the transformation of the self-managed super fund from an accumulation mode through to pension mode. One of the really big benefits within self-managed super is the ownership of an asset. And when the super fund itself changes from accumulation to pension mode, there doesn't seem to be a need there to actually sell the asset, as in to realise a capital gain. Can you just expand on that a little bit for us, Greg? This switchover within super, which is the most powerful thing for self-managed super.
Yeah, it certainly is, Ian, and as you say, that's one of the big reasons for having a self-managed super fund, because compared to other superannuation that isn't self-managed super, you tend to have to dispose of that particular asset as you move from an accumulation environment to a pension environment, and that creates tax and other expenses. Whereas in a self-managed super fund, you simply switch the fund, which is an accounting technique. You switch the fund from accumulation to pension without any of the underlying assets needing to be sold or attract any tax. So on Friday night, one can be in accumulation mode and paying a tax at 15%, and on Monday morning, you've switched to pension mode. Everything else looks the same, but the tax rate changes to 0. So you can see from there that the potential capital gain on the sale of a property becomes a very attractive outcome with a 0 tax rate. And of course, that's one of the underlying reasons that we purchase assets today, and not only real estate, but any asset, so that we can try and benefit from a capital gain. And the capital gain certainly looks a whole lot better in a tax environment where there is a 0 tax rate.
Yeah, and that brings us into the area of positive gearing. And you mentioned about paying the loan off a little bit earlier than you would normally. And this underlines the actual difference between self-managed super and borrowing outside of super, in that positive gearing is a good thing.
Yes, well, it certainly is, and of course, we don't have to be worried about positive gearing, because there's little or no tax. It's either the 0 rate or a maximum of 15%. And in some cases, even where the fund is in 15% tax mode, because of your other investments, through perhaps share investments and franked dividends, that 15% rate can be dramatically reduced. So in a superannuation environment, positive gearing is a good thing.
Yeah, and given all of that, it also brings into consideration some of the differences that you would be looking at a property. For instance, outside of super with negative gearing, you'd be looking at maybe an older property. You might look at, in superannuation, where you haven't got the tax deductions and so on, you might be looking at a newer property. So there's different characteristics that you could be looking. You wouldn't, for instance, within self-managed super, you wouldn't, for instance, purchase a renovator's dream, because one of the rules within borrowing for property within super is that you can't improve your asset. So it might not be beneficial for you to do that at that stage, or you could actually end up running into some sort of trouble with the legislation, in that your asset is changing before your own very eyes, if you like.
Well, that's absolutely correct, Ian, and that's where, that advisory role comes into play, of making sure that you speak to your advisors about the pros and cons of a particular type of property investment. I guess it's suffice to say, though, that at the end of the day, a good property is a good property. And if I can find one that is going to have a great potential for a capital gain, where am I going to want that? I'm going to want that in my lowest tax environment. And again, the self-managed super fund wins the day, albeit those points you made are very, very valid, and ones that perhaps need to be walked through with your advisor at the time.
Yeah, and speaking of help with advice and so on, the build-up of cash income to counter the current restrictions we've had over the last few years, the superannuation regime has been I suppose, put on edge a little bit by the reduction in contribution caps. And so it is important to look for strategies that may work around it. And property with this, with its associated rental income, is one of these strategies. So with the rental income, it's important to understand that this doesn't count towards any contribution cap. It's almost like an extra bonus. So this is once again a major advantage of this sort of strategy. So this could obviously, how can I say, complement someone's contributions, their concessional and non-concessional if necessary. But it's almost a turbocharge, isn't it, on income into the self-managed super fund with this rental income stream.
Well, absolutely, Ian, and I think you've hit the nail right on the head. It's the turbocharging that comes from the gearing strategy. What you're doing now is you're acquiring more wealth-creating assets. You're acquiring more assets that generate income. And it does turbocharge your self-managed super fund returns. And you've got the potential there, particularly as you make more non-concessional contributions, to keep growing your net return. So again, it is the very hallmark of creating wealth in a self-managed super fund.
Okay, now, having had a look at all of that, what do we need to do? One of the first steps, obviously, is to get onto a plan, establish a plan. Before you start, you must prepare a plan, an outline of the steps and the parties to be involved. Why a plan? Without a plan, you run the risk of missing a step or simply getting the timing wrong. Due to the strict rules surrounding this strategy, this could result in failure and substantial costs. If you get the timing wrong, things cannot be undone, and it can end up being a very serious tax penalty. During the process, Greg, when you were going through all of this and preparing your plan, what consideration did you give to gaining assistance from other parties?
Yeah, certainly, Ian. There was a lot of assistance came from other parties. Given that you have to have a solicitor to help you with the conveyancing of the underlying property, in any case, there is also a requirement to gain other legal help, and that is to do with setting up the mechanism that you need in place to be able to achieve the borrowing through your self-managed fund structure. So you certainly need the help of solicitors to be able to set up something called a bare trust, which we'll talk about in a moment, and to review your current superannuation fund trust deed, as well as look after all of those attached legal requirements. In addition to that, you need to get the lenders on side, because in a self-managed super fund, you really want to have a pre-approval for the borrowing before you go out and undertake the shopping exercise. So one has to make sure that you go through the process with the lender to gain that pre-approval, and that requires a number of steps in itself. Of course, in doing that, you need a combined approach from your accountant and financial planners to help assemble all of the information that the lender is going to need to be able to give you that pre-approval. And, of course, the things that you and I have talked about here today, your accountant and financial planner is able to help you through those. Things like, what sort of property should I be looking for? How does the rent work? Who have I got to pay it to? What things can I and can't I do with a self-managed super fund? How is it different from buying outside of a self-managed super fund? And in short, it's not a great deal different, except in the first steps. Those first steps are so important to get it right. If you don't get it right, the consequences are potentially that you could have to pay double stamp duty and things like that. So those preliminary steps and processes are very, very important. Yeah.
Okay. Well, before we go any further, I might just have a look at a diagram here that will give you all those attending an idea of just the entities involved and the relationship between them. And it's important to start looking at what we call a bear or a holding trust. I don't know about you, but a few years ago I hadn't heard of a bear trust. And so since 2007 and so on, it's certainly come into play a lot more. So due to the regulations surrounding the superannuation regime, there are many restrictions on what can and can't be done when using a self-managed super fund. And given the tax advantages, as we have discussed, and the fact that the fund must operate for future benefit of members, this is understandable. So underpinning the reasoning behind all the legislation, apart from the tax advantages, is the need to protect the existing assets within the self-managed super fund. It is vital that whatever action is taken, that the existing assets are protected at all times. A term you are likely to hear if you are to apply for a self-managed super fund loan is limited recourse. This means that in the case of something going terribly wrong, the lender will not have any access to assets other than the property associated with the borrowing. This protects existing assets. As a result of the structure that you might see in front of you at the moment, it will protect the assets of the self-managed super fund that are not involved in the property. The diagram details the relationship between the various entities, just the same as if you were purchasing a property in your own name, where you have vendors, agents, conveyancers, lenders and so on. You still have all these, plus a couple of other structures to take into account. So it's quite interesting there. Just over on the left-hand side, you see this extra stuff that's probably required by your self-managed super fund, the Bear Trust, a self-managed. You've got your self-managed super fund trust that you may have to actually change the deed on, and there's your self-managed super fund members that ultimately form the guarantor role. So on your Bear Trust, Greg, it's probably not a well-known structure for many of our listeners and so on. It's just a stripped-out sole-purpose trust, and that is to hold this property. Is that correct?
Yeah, that's really what the Bear Trust does. Its role is to hold a particular asset in favour of certain beneficiaries, and in this case, the self-managed super fund. And that property must be released to the beneficiaries on their demand. So that's all the Bear Trust does.
Sole purpose.
That's exactly what it does, and that's all it does. And it has no other assets, no other liabilities.
Yeah.
And that's its only role.
So when we actually do pay off the loan and everything of this property, and the property is transferred in its entirety to the ownership of the self-managed super fund, then there's no further role at all for the Bear Trust.
That's correct. That's correct.
Right.
It just dissolves at that point.
Okay, good. So now that we've had a look at that, we'll go back to what we need to do and obtaining. We've spoken about pre-approval. Don't go shopping without pre-approval. It would be terrible. For instance, if you're prior to having pre-approval, that you were able to find a property that you decided to purchase, only to see that while you were sorting out the various paperwork and approval documents, someone else came in and beat you to the opportunity. So when we're looking at pre-approvals, what are some of the things that lenders might ask us, Greg, on before they will let us borrow?
Yeah, certainly, Ian, and that's where the assistance of your advisors come in. Like all organisations, the lender, with regard to a self-managed super fund, will require a detailed loan application to be completed. And they'll ask you to attach pay slips and payment summaries, and for self-employed people, because what's required with a self-managed super fund is an additional guarantee by the members, not by the fund. So they will require some sort of income evidence of people, not only those on salaries, but the self-employed. So for self-employed people, you'd be required to furnish business tax returns, financial accounts, tax office assessments, and those sorts of things that normally you'd have to supply for an everyday loan outside of a self-managed super fund. In addition to that, of course, you'd have to supply the self-managed super fund financial accounts for the last couple of years, together with trust deeds, upgrades, and all of the things to do with the self-managed super fund. They also like to see audited statements, and in some cases will require evidence of the income by way of original dividend statements, etc. Okay. So that's just a quick summary of some of the things that are required on an application form. And generally it requires the advisor to have a bit of a talk through with the lender as to the overall scenario and the planning behind the application.
Yeah, and I should imagine that with some of that assistance, it would streamline the application, get it going through a little bit quicker, and therefore get yourself out into the marketplace.
Well, absolutely, and you know, borrowing in a self-managed super funds is a relatively new area. There aren't a lot of banks and lending organisations doing it. And it's very good to be able to speak to people who can talk the talk. And they know what the requirements are. And you can, or in our experience, we're finding that by having good contacts with those people, we're able to shortcut a lot of the red tape and manage to get those applications through fairly quickly.
Yeah, good. Now, on the administration side of it, there are some things that the trustees of the fund will be required to do. And when we had a look at our diagram, I mentioned something about the trust deed itself. Now, apart from that, what are some of the things that needs to be taken into consideration?
Yes, and it goes back to what we were talking about with the solicitors needing to be engaged at the start to make sure that your trust deed, of course, as you've mentioned, is ship-shape, but also to establish the bare trust and to make sure that all of those documents are flowing well between themselves. Otherwise, it's going to get picked up later by the solicitors of the lender. So that's certainly a major step that needs to be achieved in the pre-purchase approval process. I think also it's important, as well as making sure that all of those legal hurdles are addressed, it really is important to be able to sit down with your advisors and make sure you've got a good understanding of how the cash flow is going to work with your proposed purchase. You need to understand what the likely loan repayments are going to be and how they're going to be funded and what the rules are for that. Mind you, the rules aren't that complex. It's all paid by the self-managed super fund itself, as well as the income has got to be banked into the self-managed super fund, not the bare trust. The bare trust just sits there. So it's a matter of being able to plan those sorts of things, and if you do require additional income to service the repayments, where that's going to come from. So there is quite a bit of administrative and planning that needs to take place beforehand before you actually go out there and seek a certain amount of funds from the lender. Yeah.
Another important part too is obviously reviewing the investment strategy, making sure that your trust deed will allow you to do all of this. So that has to be really looked into in the very, very early stages of the whole process.
Absolutely.
We mentioned, I won't cover off on it now because we mentioned it earlier, just on sourcing the property and all the different things that you might look at in that. I mentioned the renovator's dream and so on. So we'll move on to the next slide. Now, with loan serviceability, once again, the self-managed super fund is a slightly different, has slightly different characteristics because of the different tax levels, and on top of that, because of the accessibility to funds and so on, and the protection of assets within the existing fund. So typically, a lender will look at something like a 60% of the security. So, Greg, in your experience in the loan providers that you dealt with, what did you find was the amount that they were prepared to go to?
Yes, Ian. Look, with self-managed super fund borrowing, it goes back to what I was suggesting earlier, and that is, making sure that you've got a good relationship. Your advisors have a good relationship with the lenders, because this area is very flexible from the lender's point of view. They all say that they'd like it to be at 60%, but of course they'll review every self-managed super fund on its merits. But I found that 60% was the baseline. But if we wanted to push it further, we might be able to edge up towards 70%, and that perhaps wouldn't have been too much of a problem. But as I say, it really is up to each and every self-managed super fund. They're all different.
Right, yeah. Okay, now servicing the loan out of existing assets, does this include your current concessional contributions, your SG, and any income generated by the fund's other assets such as shares, dividends, distributions?
Yes, it certainly does. And also the rent is the income that the asset is going to generate is obviously taken into account, and they tend to take a percentage of that as a guideline, and in some cases it's up to 80%. Sometimes even more, and then they will add in those other things so that they can satisfy themselves that that loan can be adequately serviced.
Yeah, and obviously the lender, knowing that they can't get access to any of the other assets within the self-managed super fund, really do have a good look at the members of the super fund to make sure that they can continue to fund and put in the appropriate contributions and so on to the super.
Well, they certainly do, Ian, and that's one of the things that, of course, relates to the interest rate that they're going to charge, and that's just a function of the risk that's applying to the whole equation. So if they couldn't rely on that personal guarantee, the interest rate, instead of being at the rates that are on offer out there in the marketplace at the moment, would be a lot higher. And in fact, earlier in the webinar, we were talking about the earlier borrowing arrangements, and they were at very high interest rates because the lenders weren't permitted to rely on outside guarantees. So they reflected that, their risk, in terms of their interest rate that they were charging. So today, the interest rates are much lower and quite competitive.
Yeah, especially when you're comparing to just a normal home loan or everything, there's not that much difference.
There's not a lot of difference. There is a slight increase on that, but it's still a good loan.
Yeah, okay. Now on the cost considerations, as we saw in the earlier diagram, there are various parties involved, and it will be important to coordinate these at various stages throughout the process. Obviously, there are fees associated with these, and it is important to get some idea before you proceed. There are also normal costs associated with the purchase of the property, and you can see some of those up there. So we need to remember that underpinning all of this are the normal processes in addition to those ones that we consider to be specific to self-managed super funds. Most people considering the self-managed super fund a borrowing strategy would be familiar with these as a result of personal property purchases. With the additional bits and pieces for a self-managed super fund, Greg, what do you think is the approximate price that, as opposed to just purchasing out in the normal world that we're all used to? Is it in the range of about $5,000?
Yeah, certainly, Ian. I think you need to budget for at least $5,000 in addition to those normal conveyancing costs to do it through your self-managed super fund. My feeling is a figure somewhere around $5,000 to $6,000 would be appropriate. Again, we talked about earlier times with this back in 2007, and we were looking at towards $10,000 then. So today, my thoughts on it are that it'd be 5,000 to 6,000 would cover all of the necessary additional costs that you're likely to incur to get yourself a blue ribbon service.
Yeah, it is interesting to see how those costs have come down. The other aspect of it is that over the years it hasn't scared people off from doing it because of the obvious potential gains with the low tax rates and the possible zero capital gain tax rate. So, at this stage, it's been a very worthwhile expenditure.
Absolutely, it certainly has, and what we're finding in the marketplace is that there are a lot of people starting to, employ this strategy, and you only have to speak to real estate agents now to see the number of people approaching them with self-managed super fund potential purchases.
I wonder if that's having some impact on our property market as we sit here.
I'm sure it is.
Now, one of the things that's very much overlooked in this whole strategy, but it, however, is a very important part, and that is a review of your insurance. That if some things might go wrong with this whole thing, the review of personal insurance. In particular, where we might have, say, a mum and dad super fund or a super fund with a couple of members. Once again, you've got an asset here that is a very big commitment of the entire fund. And if a member, for some reason, needs to get access to their member balance, we don't want to be in a situation of having to liquidate this asset in a hurry. So this is where insurance should be considered or reviewed in the overall aspect of the entire self-managed super fund. We mentioned earlier about reviewing the investment strategy, and that all comes into play, doesn't it?
Well, absolutely, Ian, and I think the insurance argument is a very, very strong and compelling one in a self-managed super fund. I mean, I'm sure not everyone realises that you actually get a tax deduction for your premiums for life insurance in a self-managed super fund. So, you don't want to be left in a situation where you are forced to sell a property and perhaps the timing just isn't quite right at that particular time. So it is always prudent in a self-managed super fund to consider life insurance, and even more compelling when you have a gearing strategy in place.
Yeah, and that's why you do need that professional help to assess those things and also to help have that plan B in place.
That's correct.
Okay, so now the next steps. Now, after considering what we've been through and so on, Greg, I'd like to thank you for sharing not only your experience in regard to this matter today, but also your valuable insights. I trust that our participants have had some of the mystery removed from the strategy, and they can now progress with confidence when they seek some assistance. If you're serious about this strategy, the first thing you need to do is to talk to a financial planner or advisor. They will help you to establish the borrowing capacity, review your contribution caps, and prepare the necessary paperwork so you can go shopping for a property. A good advisor will act as a project manager for you. Now, Greg, just in wrapping up, have you got any other parting final comments?
Ian, I think we've covered it fairly well. It's a complex area, but as you can see, I'm very excited about the opportunity for members of self-managed super funds to gear in their self-managed super fund. It doesn't have to be property. There's many other opportunities, but today we've been discussing property. So yes, I am excited about it. There's many good tax reasons and diversification reasons that you'd want to perhaps look at this. And Ian, it's not for everyone. Gearing in a self-managed super fund is not for everyone, and that's why you need to speak to your advisor about it. But in the right circumstances, I see it as a great wealth creation tool, and we're going to see it used more and more often in the future.
Okay. Thanks, Greg. And as I said, thanks for your input. Now, in closing today's webinar, I'd invite those interested to contact our office for an assessment of their situation. This may include a face-to-face meeting at no charge. I thank you for connecting to our webinar, and I will leave our contact details on screen for a few more minutes to allow time for you to jot down those contacts. So thank you and goodbye.